So let's, and can you give, I know I did read a piece that you did, and I think it's on your website, called Financing Diamond Projects, like, which does have a lot of the economics behind diamonds discussed in there. But can you give us a sort of a financial forecast as to what the market looks like according to your version of the world?
If I could answer that maybe in two parts, Matthew. The first part is from a financing perspective, and the second part is trying to get a crystal ball out in terms of where the future will be. From a financing perspective, much changed post the global financial crisis in 2009. Up until that point, you had large equity firms such as BlackRock and JP Morgan and others who would always take a 10% or thereabout slug of any diamond exploration company which they viewed had particular merit. And from that, they were able to actually get a good slice of the kind of diamond income that would come through from an uplift in those growth stocks. Post 2009, the market changed considerably, the risk profile changed significantly, and the funding of diamond juniors, which has chiefly been the engine of exploration growth around the world, essentially dried up from those firms. And my chairman, Dr. John Teeling, has got a great saying in that post 2009, it essentially became the role of the three Fs: friends, families, and fools, who would actually fund these diamond exploration ventures. And so it's become a lot tougher to fund this particular sector. But notwithstanding that, there is still support behind it. And in particular, things such as crowdfunding, royalty streaming, and other means are used to actually fund it. So going on to the second part of your question about a crystal ball going forward. Clearly, with the global pandemic around COVID-19 and the coronavirus, there is a major transient event which is taking place around the world at the moment. Many mines have actually stopped production. Those people with discretionary income are obviously holding on to that income because most people, everybody, is uncertain about where the future will be. So that has actually had, unsurprisingly, a downward trend on diamond prices and a downward trend on diamond production. So I would not want to actually, it's way out of my field, as to kind of forecast in the short to medium term as to whether there will be a V-shaped recovery, a U-shaped recovery, a recession or a depression. That's well beyond the remit of somebody like myself. But the one thing that I can say is from a long-term perspective, and that's certainly what we look at in the diamond market, is that there are fewer and fewer diamond mines being discovered. And certainly if one looks at a generational timeline, we still think that people will buy diamonds to celebrate a rite of passage. We still believe that they will be natural diamonds and they won't be replaced by a synthetic alternative. And with that divergence over time in terms of supply and demand, the only way that that can converge is by diamond prices exhibiting real growth over a long period of time. But that long period of time, I don't really know what that would be because of where we are at the moment, and we're still not on the downside of the pandemic as we see it.
Because you do talk in your PowerPoint about the fact that it is harder for diamond explorers to get funded. At the three Fs, that's a good one, probably applicable in a few commodities, and the junior funds and institutions moving away from funding junior exploration companies. That's been a trend of the last 5 years. You think was there less money around and less interest around and less funding for diamond companies like yourselves? You'd think that that would be a good thing for the overall pricing in the marketplace, wouldn't you? You suspect, well, there's less being found, there's a bit more rarity, less supply in the market, a certainty around supply in the market going forward if the growth is as you say. That would be good for you, wouldn't it?
Absolutely, Matthew, but I think one must look at the timing behind these things as well. I think everybody buys into the supply-demand gap, and everybody buys into the fact that new producers will actually have to come in to fill that gap. But what you typically find is that it might take anything up to 10 years, between 5 and 10 years, from a discovery through to actually mining itself. And I get a sense people looking at much shorter term money in areas where they can get a much quicker return than rather wait for that discovery to take place and wait for that mine to go into production and start actually producing dividends. I think a trend that I picked up when I was at the PDAC in just before the pandemic kind of came up is that majors seem to be getting more focused into exploration itself because they understand, of course, the supply-demand dynamics very well, but also because they can actually write their own checks in terms of their own exploration, and they're of course bound by their own rules. Those are more internal than those actually which investment companies have to adhere to when investing in junior companies. It's when you're investing in exploration stock, irrespective whether it's diamond or elsewhere, you're doing a number of things. You're banking on the team. The team knows what they're doing and they've got a successful record of discovery. Secondly, they're in the right area from a prospectivity perspective or a geological perspective. And then thirdly is that there is acceptable political risk in those countries in which you are operating. So my view is that the funding and the majors will gradually kind of catch up when that supply-demand gap becomes so wide, and then it will take some time to fill that, because obviously exploration, you can't go out and find a diamond deposit tomorrow and then turn on the mine next day. It's a fairly long, sophisticated process, which can give very, very good returns. It needs patience. So I think there will be a lag, to answer your question, in terms of funding behind the diamond exploration business.
Okay, I just want to throw something at which is kind of like common sense thesis thought process that we're trying to go through. So if I'm looking at the macroeconomics of the world at the moment, I'm seeing more and more people in debt, more and more credit card, people get, suffering from the high rates that they're being charged on credit cards, and they're having less and less money to spend on needs, let alone wants. So needs being obviously food, energy, home, travel, all of those wonderful things, and things like diamonds, that's just a luxury, which I feel that quite a few of the generation, behind me, isn't going to be able to afford anymore. I mean, so how do you do your forecasting based on, what do you base the forecasting on?
Unlike many other markets, such as the gold, copper, coal, and other markets, where you can actually read about the price of that commodity in the newspaper, and it goes up and down, and it's very transparent. You can look at historical trends, try and forecast into the future, and although nobody's perfect, you get some kind of idea about the future itself. The diamond market is a very much a multi-tiered market. At the one end, at the very bottom end, you have very small diamonds, which are poor quality, which would basically feed the bottom end of the market itself. At the top end, you have large diamonds, large colored diamonds. And the difference in prices between these two is astronomical. This market here tends to be the ultra high net worth individuals, who of course would have lost money during this particular pandemic and with the drop off in the stock exchanges. But relative to what they actually have at the moment, it would be small. So if they choose to still buy a large pink diamond or a large type 2 white diamond, they will still buy one. So the volatility in this market in terms of pricing and in terms of demand is very different from this side, where exactly as you said, Matthew, people are going to put bread on the table, petrol in their car, pay their mortgages, etc. And luxuries such as a diamond, a holiday, a branded piece of jewelry or a handbag or something would all be subordinate to actually what are the real requirements. So this market here has dropped significantly in terms of diamond demand and diamond pricing, but also interestingly as well is synthetic diamonds, and maybe the greatest or largest example of that is the Lightbox initiative by De Beers, are also filling this segment, and these are coming in at a lower price because they're more readily available and they're not anywhere near as rare as the natural diamond. So what we are seeing, and it's no different if one looks at the sapphire industry, the pearl industry, and other luxury stones such as this, is you're seeing a multi-tiered market as such. Naturals, high-end goods here, focusing on one market, synthetic low-end goods here, focusing on another market, and of course many other tiered markets actually in between.